Welcome back to the IB Investor channel, and in this video we'll take a look at Hemnet's most recent quarter. For Swedish investors and people living in this country, I don't think Hemnet needs an introduction because it's a super common web page here in Sweden for the real estate market. But for the foreign investors, Hemnet Group is a digital marketplace for housing in Sweden. Anyways, in this video, we'll check the share price development, we'll check the sales and profitability, we'll cover the cash flows, debt situation, the dividend, and also the CEO remark. Now for the share price development, we don't have a lot of history, as you can see. The stock IPO'd here, and post-IPO, investors could make some, fast money here on the fast return. But if they bought over here, the risk is pretty high that they lost money because the stock went down for a couple of periods here. But we can see though that the stock has recovered pretty nicely as of late. So for the past year, almost 44%, and year to date, almost 57%. So that's pretty good. It's much better than most stocks out there actually. So investors who bought here when the market was worrying, you probably made a lot of money here. Other than that, there's about 6,300 shareholders here at my broker, so not the most commonly owned shares, but yeah. Now for the net sales of this company, and we can see that the growth had been pretty good historically speaking, but we have to bear in mind here that during this period the company was probably unlisted, so the numbers here, they should not be trusted to 100% because management doesn't have to, post profits in the same way as they have to do here. So we might see, net sales, those figures you're probably not changing, but at least for the EPS here, as we can see in the orange, here's certainly something that happened when the company became a listed company where, they probably focused a lot more to make money compared to anything else, because that's normally the case when a company becomes listed. Going back to the net sales, we can see here for the most recent quarter that, sales have slowed down. So we can see the net sales did grow here nicely, but here it slowed down. The EPS growth, as I mentioned, we don't need to mention the history so much, but we can see here that it's still growing, but it's not growing that fast. It's actually pretty slow growth here in the most recent quarter, especially comparing it here to 2021. Looking at the gross margins are high still at 67% here, or 67.5%. Profit margins are also quite strong here, or very strong, I would say, at 32.2%, which is very good. However, we can see that, for example, the gross margin here in 2021 was 82.4%. Unfortunately, you can't see it from your end, but the company has posted a much higher gross margin in the past. So, I don't know. The company has lost some of its, earning potential as a consequence. I would imagine if they could come back to, the high 80+% levels, then I would assume that most of that would, trickle down to the, profit margins as well. So management has some work here to bring it back to these levels, and obviously it has been possible in the past. So it's, in my opinion, should be possible going forwards as well, just looking from the sidelines at least. We won't dwell on this for too long since it looks so good, but the company here is posting a very nice, almost 35% free cash flow margin, and we have seen similar high margins here. Obviously not this high historically speaking, but we have to remember that this period was the unlisted period. But when the company was listed here, we can see that they posted a very nice 30+% free cash flow margin, which is very good. Even for a tech company, this is good numbers. Comparing it then to Evolution, which is also a tech company, but obviously in a different business, 55.6%, and Fortnox within the finance here, 17.3%, but still very good numbers here for management. Now for the free cash flow per share, paints pretty much the same picture as the margins. We won't dwell on that, but we can see here that this company offers a free cash flow yield currently at 1.67%. So this is just one of the first steps that indicates that this company is very overvalued right now from a free cash flow yield perspective. And we got to remember that this company, posted a 30 plus free cash flow margin. So the question is, how much higher can it go? I doubt that it's going to double. If it doubles, then obviously the yield here will double and that will look like a better proposition. But currently, it's quite a low free cash flow yield, I would say, for a company. I can also mention then that the number of shares are down from like 101 million down to the current 98.4 million. So the company are decreasing their shares outstanding as well. So there's no dilution here happening that would affect these numbers, but rather it looks like the opposite is happening. So they're removing some shares here from the float, which is very good. Now for the cash flow overview for the company, and we can see that this company, I think we shouldn't look too much, or we shouldn't read in too much about this period again, as this company was unlisted back then. But at least looking here, they're producing very nice cash from operations here, ever so improving. Obviously, not a big step here year over year from the most recent quarter here from 2022, but still it's higher. We can also see here the free cash flow in the greens, which is very good. Even though it's declining, it's still a very high level for any company to produce such good cash from operations, basically convert to free cash flow. But as a consequence, capex here, as we can see, the investing side of the business is quite low, so they're only spending like 35 million, 15 million. So this company isn't spending a lot of money on capex, which is quite surprising. I would have assumed that they would have spent more. But yeah, very good cash flows, I would say. This is this is a seriously good business looking from the cash flow perspective, at least. Now comparing the net debt to cash from operations, and again, we're not going to mention this period behind here, but at least here in 2021, 2022, and so on, we can see that the net debt has gone up a little bit, but it's not worrying here. Cash from operations is covering the debt. Here, cash from operations are covering the debt, but here the gap has increased now, so they actually have more net debt than comparing it to cash from operations. So if the net debt were to, increase by a lot in the next quarter, and in at the same time, the cash from operations are either stagnant or declining, if the gap increases here, then investors should be a little bit worried going forwards. But we're not going to be able to see that until the year is finished. So it's going to be interesting to see in the next report here that comes in a few months, to see whether or not this gap has improved, becoming bigger, or if the gap is narrowing. So it's going to be interesting. But right now, there's nothing alarming, in my opinion, when looking at the cash flows right now. Now a continuation from the previous slide here with the net debt. So here we have the net debt to EBITDA, and we can see that the company for the most recent quarter here posted a 0.82 times multiple here, which is very low. And we've seen, historically speaking, this is the unlisted period, it has been much higher, but at least for the listed period, the net debt to EBITDA has been very low. But also comparing it to some other tech companies like Evolution here, that sits at a negative, and also Fortnox that sits at a negative. This company actually loses here because it has a positive, and positive in this case is bad or worse. So, but a 0.82 times multiple is nothing alarming either. So it's not that this number is bad. It's just that the peers that I selected here are so much better. Now for the enterprise value to EBIT, and we can see that the multiple here is very, very high at almost 50. Now this, in my book, would scream overvaluation, unfortunately, so this company is not investable for me. I would like this company to go down to, maybe 20, 25, best case, even below that, but as it is right now, it's not investable for my sake here, because it's just too high of a multiple right now. Looking historically speaking, it's been higher though in the past. It's been lower on occasion as well. Remember the share price decline that we had in 2022, this would have been a much better proposition, but still very high. Comparing it then to Evolution, and that sits at almost 17, and Fortnox at almost 44 times here. So, you know, there are other companies out there with lower multiples, but 50 times, that's way too much for me. I mean, I would like to see a 50% decline or something before it even looks interesting right now, unfortunately. Now for return on invested capital, and I would say that management has done a, okay job considering 16.1 is not bad for many companies. It's a good figure, but this is a tech company as well. You have to remember that. So comparing it here to some peers that sits at 30% and 34% almost, management for these companies have done a tremendous job here. So comparing it then to Hemnet 16.1%, I mean, it's not impressive, so to speak, but again, 16%, it's not a bad figure. And certainly since they have almost doubling it here from 2021, management has improved it over time, but I would like to see it at like 20%. For this valuation, I would say, I mean, I would at least expect it to be, somewhere similar to Fortnox or Evolution at 30%. But yeah, that's a different story. Now for the dividend per share, we can see that this company has actually paid out a dividend here. So in 2021, they paid 0.55 kroners a share, and they increased it by almost 82% here in 2022. And this was probably paid out then in 2023. So very nice dividend increase, but you have to bear in mind here as well that, the dividend yield currently is like 0.51%. So you're not going to get a big dividend yield here when buying the stock at current levels. But this is what I mean as well. I mean, I don't think it would hurt if the stock could come down like 50% in share price decline. At least that would mean that the company would be out there offering a 1% yield instead of half of that, which is currently at 0.51%. So yeah, not so nice, but I mean, at least the dividend increase, the growth here is kind of insane, but I'm not sure how sustainable this is currently, but it is what it is. And this CEO remark, I mean, I couldn't find that much that was interesting, honestly. And that's the case with some of these CEO letters. Like some of them are super honest about what's happening in the business, and some are more vague. And I didn't think there were too much highlights here. So I think we'll just focus on the numbers because those were the ones who were interesting. And since we went through the quarter, I think the assessment here that they had a pretty good quarter. I mean, not not to say that there are challenges obviously in the company, not to say that their customers have challenges. Obviously, the brokers here trying to sell these houses and apartments and so on. I mean, there is a big struggle in the real estate market right now where sellers aren't able to sell anything and buyers aren't willing to buy it because of financing. So, either the prices has to come down a lot or the financing has to become cheaper. So somewhere they have to meet. But currently the market is not working. It's not functioning good enough, to make enough sales. So I would assume that Hemnet makes a lot of money from these ads continuously somehow, because that's what she calls them, ads. So when a person or when a broker or real estate broker, places a house for the market, I think they just call it an ad or something like this. But yeah, challenging obviously in the market, but this company is printing money right now. So I would just assume that they have some, continuous invoicing for these ads to make up for the lack of sales right now. Otherwise, this company wouldn't make any money either. But that's the only thing I can take from this. That she does mention, some challenges, but we don't see it in the numbers. The numbers are actually pretty solid and good. So I think that will be it for this assessment for the CEO letter, because I can't make much sense from it. Obviously, they're making a lot of development within the company to develop new products and so on, better client offerings and so on. But yeah, the numbers I think speaks volume rather than this CEO letter right now. All right, this was it for the most recent quarter here for Hemnet. Thank you very much for watching. If you liked the video, please hit the like button below and subscribe for more content. Goodbye.